Good afternoon, everybody. Welcome at this webinar of Carbon Equity, where I will focus on the infrastructure opportunity and why we think this is an exciting time to invest in climate infrastructure. So let's get started. What can you expect? We'll present for 20-25 minutes the case for climate infrastructure, and then at the end we'll leave some minutes for questions that you might have. Feel free to write your name and your role in the chat. Also, feel free to ask any questions in the Q&A section. We will have time at the end. If there's anything in between whereby we think is worth addressing, we'll address it along the way. So feel free to send any questions you might have. So what will we be discussing today? First of all, I'll give a brief intro on Carbon Equity for those who don't know us yet. And then we'll walk you through why we believe it's an interesting time now to invest in climate infrastructure. The role infrastructure can play in portfolios, the key characteristics that infrastructure has, and we think it has some unique characteristics. And then finally, how we select funds and give a few examples of funds that we've already committed to. So this fund has already started deploying. And then finally, we'll leave some time for Q&A. So today, Eva will present together with myself. Both of us are in the investment team, and we've been active in the infrastructure space now for close to 2 years. So we've seen a lot of funds and are very pleased with the traction so far. So pleased to walk you through our excitement, and hopefully we can share it with you. For that, so who is Carbon Equity? We are an investment platform that offers access to climate, venture capital, private equity, and infrastructure funds. And we do that by pooling investments from multiple investors into a fund. And with that fund, we invest in underlying funds. So a so-called fund of fund. It's a diversified way to get access to private market funds. And we believe it's a balanced way to get the right risk return out of such an investment. We have raised 300 million so far from over 1,300 investors, and we've selected 25 fund managers so far, and have backed more than 200 underlying portfolio companies. So that's venture capital, growth equity, buyout, and infrastructure. So it's we've been well on track, and we've been doing this now for 4 years. So what do we focus on? Our climate tech portfolio fund focuses mostly on venture capital and private equity opportunities. So these are really technologies that are still in development or that need scaling up. Could be really breakthrough stuff like nuclear fusion, but also synthetic aviation fuel, for example. That is not part of today's topic. So today we'll focus on infrastructure that's really more mature technologies like battery storage, solar PV, EV charging. We'll give you some examples today. But we have 2 products that cover the entire private markets equity spectrum. Not only we cover all stages, from early stage to later stage and to infrastructure, we also want to make sure that our products invest in all the segments where there are heavy emitting industries, and we need to decarbonize all of them. So energy, mobility, industry. With our platforms, we really aim to cover the entire universe and the entire economy. But today we're going to focus on infrastructure, and why we believe, especially now, is a good time to invest in infrastructure. So first of all, it's growing very fast. So the investments in renewable energy has been outpacing fossil fuels for the past couple of years. Where fossil fuels have been declining, renewable energy generation and investments in renewable energy has been increasing year over year. So it's an exciting, growing market opportunity. And one of the reasons why this is the case is that it's fundamentally a more efficient way to, for example, generate electricity on the left-hand side of the slide. If you compare electricity generated with fossil fuel, there is a much higher efficiency if you generate it with wind and solar versus just burning fossil fuels. There's a lot of losses along the way. So 2 to 3 times more efficient way to generate energy. But also if you then use it and heat your houses, for example. If you do it with a gas boiler, you have a lot of losses. But if you use heat pumps, you can extract heat from the air, and you have a 300 to 400% higher efficiency by using electricity and heat pumps. And then finally, even if you look at the passenger cars, the efficiency of electric vehicles is much higher. You lose much less energy in the form of heat when you use an electric vehicle. So it's just fundamentally a better technology. And for any newly built technology or industry, we think the electrified version makes much more sense, also from a unit economic point of view. So what you see is that the prices have come down over time of many of these technologies. So looking at solar PV, the unit cost has come down dramatically. And the same we've now experienced for batteries. And the good thing is, if the costs come down, the adoption curve goes up. So if you look at the terawatt hours of solar generated across the globe, it's increasing year over year. And battery storage in the past couple of years is really exploding as well. And for every 20% of additional deployment, you see that the costs continue to fall. So it's really a dramatic improvement in unit economics as a result. And we expect similar cost curve declines for other technologies, maybe not all to the same extent as battery and solar, but overall, with increased adoption, costs will come down. And once that happens, you enter this vicious circle. So renewable and battery costs get cheaper. More clean technologies that actually use that cheap electricity will be deployed. You can think of heavy industries, trucks, even the way we make steel and cement. So more sectors of the economy can be electrified, and that will increase again the renewables and batteries, which will result in cost decline. So we think this is unstoppable right now. But it's not only the fundamentals that are favorable for electrification versus fossil fuels. It's also that the whole global economy currently is very much focused on energy independence. From Russian gas in Europe moving to LNG from the US, we're still heavily dependent on imports as a European continent. But not only Europe, also if you look at China and South Asia, there's still a heavy dependency on imports from fossil fuels. So if you want to become energy independent, doubling down on renewable energy generation, storage, and electrification is the way forward. And we think in the current macro climate, this is more top of mind than ever before. And even here in Europe, especially if you look at the Draghi reports, it's very much focused on reducing this dependency on other countries and increasing independence. So there are big drivers that are favorable for this transition. But it's not only energy independence from a macro point of view. There are also other drivers. So for example, the artificial intelligence boom is really driving adoption of renewable generation. We see it especially in the US, where it goes really fast. Companies like Fervo that does geothermal at grid scale sign major contracts with huge hyperscalers. Also microgrids that can be deployed very fast compared to nuclear or compared to new gas plants. So the adoption of renewable energy to fuel this AI boom is phenomenal, and results again in lower cost prices along the way. So big demand drivers as well, and we expect to see the same in Europe.
Yeah, so this huge opportunity is already being addressed today, and that's happening by several infrastructure players. So I will give you two examples on in what ways that is being done. So for example, on the left-hand side, you see independent power producers, and these are clean energy suppliers that generate renewable energy closer to where it's actually consumed. And this helps us moving away from fossil fuels, but it also addresses the network congestion, which is a problem that we almost face everywhere. And these IPP, so these independent power producers, they sell their energy to utilities and to corporates at fixed prices. And this is super beneficial over all the fluctuating energy prices we see in the market. And these fixed prices are secured through contracts between the supplier and the buyer, the PPAs, which you can see in the middle. And these contracts last for 10 to 20 years, so super secure revenues as well. And this market for the PPAs is actually booming. So it's doubled in size between 2022 and 2024 already. And it's also facing some policy tailwinds. So for example, from the new Clean Industrial Deal of Europe, they will cover parts of the contracts and making the offtake of the contracts less risky for these independent power producers. And I'm moving to the right side of this slide. There are also microgrids being developed, and these are smaller scale localized energy islands, kind of, where energy can be generated, stored, and used whenever that is necessary. We can disconnect them from the grid so they can operate independently. And we see them more and more, especially as Wiebe mentioned with the data center play. We need to power them. They require 24/7 energy, and it's more reliable and cheap this way.
Great. So those are two examples. But why is it sensible to add climate infrastructure to your portfolio? So from a portfolio point of view, why does it make sense? So we think climate infra funds offer really some unique characteristics, especially compared to venture capital and private equity funds. If you look at the risk return profile, it's very balanced. So the underlying projects typically have limited technology risk compared to the earlier stage programs that we have. They're secured with long-term contracts, like Eva just explained, and they're managed by very established funds. So it's from a risk and maturity point of view, clearly lower risk than venture capital. But also from a capital deployment point of view, if we look at the infrastructure funds versus venture capital funds, they deploy much faster. So within the first 2-3 years, the majority of your investment is already at work. Whereas in venture, it can take much longer, 5-6 years. So if that's important, having your cash at work fairly quickly, infrastructure is a good product. And then if you look from the impact point of view, many of these technologies, they're either already constructed and operated, or they're still being built, but it takes, let's say, 1 to 3 years to get the projects up and running. But from that moment onwards, there is a direct impact. Whether you generate electricity, you store it, or you use it, it's a mature technology. So from the day it is operational, you have that impact versus a fusion investment. Maybe one day in 10 years, you might see an impact that results in greenhouse gas emission reduction. Now, so what are some other characteristics of infrastructure projects? What we believe makes it a solid and sound investment? I think the contractual offtake, Eva discussed it. It's a very important point. Majority of the projects do have these offtake contracts in place, which just secure long-term revenues and cash flows. So it's very stable. You know what you will get once such an offtake contract has been signed. So no year-over-year volatilities, much more secure. Typically, there's also a link to inflation in the price agreements. So whatever inflation does, you will be rewarded for it. And overall, there's less dependency on economic cycles. Sure, demand might be a little bit lower, but in some contracts, you also secure the volumes, and you can even sign away those type of risks. It's essential infrastructure. It will remain in place over the life of the asset. And typically, you have very reliable counterparties, large corporates, big utility companies that are the counterparties. The funds also have a much lower loss ratio than venture capital funds. So the number of projects that are actually loss making is very slim. And it's a result of the fact that it's more mature technology. So obviously there is risk. There's still some development risk. There's still some construction risk. It's never without risk, but compared to the venture capital and private equity programs, it's really, really a different risk profile. So from a portfolio point of view, if you're looking for some stability, but still want to have impact and want to support the rollout of very essential technologies that we need to get to net zero. The infrastructure product offers that. So what type of technologies can you expect? Well, if we look at the maturity of the technologies, then 55% of all the emissions are actually already can be solved with technologies that are so-called in commercialization. So what we believe are mature and proven at large commercial scale. Really on the outer end, it's solar panels, it's wind, it's storage. That is really proven. It's rolling out at global scale. But the next couple of technologies are really out there as well. So renewable biogas, EV charging networks, but even microgrids, hydrogen in certain use cases, industrial heat pumps. These can all be in scope for our infrastructure fund, as long as it's really scaling them at large scale. Then it's in scope for us. What's not in scope is on the left-hand side. It's really more early innovation, carbon capture, green steel, anything green cement-wise. That's too early. It's still unproven. So that is not part of our strategy. So how do we make sure the right funds end up in there? So we have been tracking this domain for 2 years now. We've spoken to many funds along the way. And we have a very strict diligence process, similar to the process that we have on the venture capital and private equity side, whereby we assess any fund from a climate point of view. Do they invest in the technologies that we believe are needed to get to net zero? We do a full financial due diligence on the funds, and ultimately we'll select 3 to 5 funds within this fund to get the climate infrastructure product up and running. Now, what type of funds are in scope and what are not in scope? Because there are different type of infrastructure funds. Let's start with the ones that are not in scope. It's so-called core infrastructure. So core infrastructure means you buy a operational project from another shareholder, and it's already throwing out dividends. It's very stable. It's low return, but also your euro that you invest goes to the selling shareholder. For us, it's super low risk, but it's not the type of projects and a type of assets that we want to invest in. We want to invest in any opportunity, any developer and its pipeline, whereby either they have already some operational assets, but are still building new ones. So Core Plus, for example, it's a combination of assets in operation and a pipeline, a development pipeline, or funds that really focus only on newly built stuff. It's more value add, it's higher risk, but there you don't buy into existing operating assets. So we like the latter two better because the euros are really put to work in new projects. So from it's not true additionality, but at least you're funding new projects with your capital. Also, returns are slightly higher. There's more construction and development risk, so you're rewarded for that risk. And any of these projects should reach somewhere between 10 to 14% net IRR. And once they're operational, there will be some dividends. Those dividends can be either distributed to the investors, or they are reinvested in the pipeline and they develop new projects. So that depends a little bit on the type of developer, what they do. So this slide gives an overview of what the fund would look like. Look through. So strategy-wise, approximately 50% of the fund would invest in core plus infrastructure and 50% in value-add infrastructure. So we're trying to find a balance between the two. And then if you look at the underlying assets, the vast majority of the funding will really go in building the underlying projects. And some capital will go in funding the developers who are actually developing those pipelines and those projects. It's a little bit of a combination of the two, but the majority really goes into the underlying projects. It's more European focused fund. 75% or more will be Europe, some rest of the world. It will be OECD countries, probably North America, but the majority will be in Europe. And then sector-wise, approximately 80% we believe will have an angle with energy, could be generation, could be storage. But it will also be some other technologies. Could be transportation, EV charging, could be industrial heat. So it will not only be generation, it will be very much storage and other use cases as well.
Yes, so I will walk you through some examples of the funds we invested in and the projects we indirectly funded as well. I've seen 2 questions so far in the chat, but let's address them at the end, and please feel free to put other questions in the chat. So presenting to you our first commitment for this climate infrastructure fund, and that's in a fund manager called R Green. And yeah, we invested in our 5th fund, which is called InfraGreen 5, and super established manager raised our fund 5 and doing this already since 2013. So they invest in really ready to build infrastructure energy projects with a focus on Southeast Europe. And they really target places where grids still really heavily rely on fossil fuels. So they achieve a high impact delta. And if you go to the next one, then I will walk you through some examples where our Green invested in. So no, one of the investment examples. So
Yeah.
Eco Energy first.
Apologies.
No worries. Is that this one? Yeah, great. So this is Eco Energy. So this is an example of an investment our Green made. And this is an independent power producer. So I discussed that earlier. And they roll out solar and wind projects on a super big scale. They have quite a big portfolio already, 1 gigawatts live, and a pipeline of 7 gigawatts of more projects. So they have projects in different parts of Europe, and they sell energy via these special contracts, so via the power purchase agreements, but also sell it directly through the grid. So they have 2 streams of revenues. And then the next one is NW Storm. And they combine EV charging stations with battery storage. So why do we need that? We need it because then you can charge your car almost everywhere at any moment in time. And this is great for European rollout of EVs, as charging infrastructure remains a critical barrier for further adoption. And then we go to the second investment we made. So that's in Amnes Capital. That's the name of the fund manager, and the name of the fund we invest in is Cap Energy 5. And they are also super established, investing since 2006 with this team. And compared to our Green, they invest a bit earlier in the development process, in a development phase of these projects. So they're really a bit more entrepreneurial, and they're also targeting thereby a bit higher returns. And I want to highlight 2 investments there as well. So first one is CCE. They develop solar projects and also combine that with battery storage, also to eventually become an independent power producer. They have quite a big portfolio compared to the other I mentioned. So 2 gigawatts in projects already, and super diversified across different regions. So in France, they have one in the Netherlands, in Chile, in Italy, some more. And then finally, Enova. What they do is they repower old onshore wind projects to put them to work again, make them more efficient, and roll out, acquire these projects and upgrade them. And are currently really benefiting from German tariffs that are in favor of renewable energy rollout. So these were 2 fund commitments we made, the first 2 fund commitments we made with this fund. And if you go to the next slide, we can show you a bit of our pipeline. So these were 2 different strategies in terms of when in the project development phase the infrastructure manager invests in. So also a bit different risk profiles, but similar in kind of the technologies you go after. So you saw battery storage, solar, wind, and for the next commitments, we're really also looking for some diversified exposure in terms of technology. And these are 2 good examples of that. So think about microgrids, renewable bioenergy, thermal, solar, with which you can create heat from solar and use it in industry and commercial buildings, for example. And then finally, we want to present the opportunity that we have been presenting so far. So this is Climate Infrastructure Fund 1. We expect to fund around 40 companies and projects projects with this fund, and we're closing probably a bit before summer. So let's move to Q&A. I think that's a good time to dive into that. Maybe a question for you, Wiebe, a bit more high level. So how are policy changes in the US expected to impact EU climate-related companies?
Okay, that's a broad one. So policy changes in the US mostly affect US companies, to be fair. So if we focus on infrastructure, the Trump administration has been pretty negative when it's about offshore wind, for example. So offshore wind got killed overnight. So how does that affect the case for offshore wind in Europe? It doesn't really. Offshore wind is a tricky one in Europe as well. Very dependent on inflation and what interest rates are doing. So whatever the US does there doesn't really affect the European markets. I think from supply chain point of view, tariffs wise, the majority of the supply chains come more from Asia. So if there's overcapacity as a result of policy changes in the US, it might actually result to lower prices for products that we can source from as Europe from Asia. So I don't see many supply constraints for European projects that depend on US parts. I think that's fairly limited in the bigger scheme of things. So I think overall, I think that impact is not direct. I think where we do see an impact is more on the earlier stage side, where many US companies are now looking into moving to Europe. Let's put it that way. Either building their next plant in Europe or just moving overall to Europe. For example, we've seen some hydrogen-focused companies moving from the US to Europe because it's just more favorable climate to operate in. So that is just beneficial for Europe on the one hand. More companies will come here, more talent will come here. So that's an indirect effect of policy changes that we'll see on Europe. So more competition for European players, but overall more companies that are offering their products here and want to build their factories here. So I think from a job creation point of view, it's a great opportunity, and Europe seems to be awakened to the fact that this is a pretty unique moment in time to double down on the strategy.
Great, thanks for that elaborate answer. Then we have one more technology-related question from Nina. So where are the microgrids being developed? We see them being developed in the US already, like in Texas is a state where it's being deployed, but also in Europe. So even in the Netherlands, I think, and in the global south, because there you also need independent energy. They are grid tied. That's also part of the question, but they can disconnect from it. So they can operate by themselves too, but they can also connect to it, sell energy to the grid and get energy from the grid. So I hope that answers your question. And then we have another question from Edmond. An IRR of 10 to 14% seems high at a low risk profile. How do rates compare the risk?
Yeah, so I think 10 to 14% is high compared to bonds or core infra. It's low compared to venture capital, where you really want 25 to 30% IRR. So when I say it's a more moderate risk return profile, is really compared mostly to venture and growth equity. So that is a fair comment. Because overall, if you can achieve 10 to 14%, obviously it's great. Now, why is it 10 to 14% and not 5% if it's so low risk? Well, that's because it's not fully low risk, right? You still have development and construction risk. There will be some interest rate exposure that you will have. So if I gave you the impression that it's without risk, that's unfair. Compared to venture capital and growth equity, it's lower risk, and that reflects the 10 to 15 versus 25 to 30 that you would expect in venture.
Great. And another product-related question. So how long does the fund run, considering that the ROI is much faster compared to the other funds we offer?
Yeah, so the underlying funds that we commit to are 10-year closed-end funds. We ourselves have a up to 2-year investment period. So our fund has a 12-year fund life. But I do think that from a cash flow point of view, indeed, cash will be at work faster than with the other product. And I do expect earlier cash flows, but it's still the same length due to the type of funds that we invest in with a 10-year fund life.
Great. And then 2 more questions. So first one is funding put into nuclear energy. So it's not being done with this program. It is being done with our other programs, as these nuclear energy technologies are a bit earlier stage and not yet at the phase where we can deploy them at large rollout. So not with this program, I would say. And then another question, what's your view on the type of renewable energy infrastructure the future energy system needs? Most examples in the presentation seem to target large utility scale projects, but how do you view smaller microgrid type projects, and how do you get investments channeled into those smaller projects? I think it's a super good question, and I think it's also exactly where our sweet spot is to like fund mid-sized fund managers that actually can funnel investments into these types of earlier or smaller scale projects. If they make these investments and the projects turn out to work well, they become bankable and become ready for these large infrastructure project funds or banks to be rolled out on even larger scale. So I think I would say maybe Vivi have anything to add, but I would say we target these types of projects.
Yeah, no, you answered it already. I think indeed we did not address it here in the presentation, but for us, the mid-market is really very attractive at the moment to invest in. We back managers who have local presence, who know all the local developers and those founding teams, which is needed if you want to invest locally in Poland or in Spain or in Italy. But the good thing about the mid-market is that apart from the more distributed nature of the assets, is also you can build out your portfolio and then you have more exit routes. In the end, we also want you to make a return. So the mid-market can sell to the larger infra funds, they can sell to the utility companies, and once the IPO market is back, they can IPO. So having that optionality, we believe, is interesting. Smaller independent power producers, microgrids, that's all in scope for these type of funds.
Great. We're 2 minutes past time and run through all the questions. So good timing, I would say. So thanks a lot for attending. Good audience. And, let me know if you have any other questions. You can reach out through Carbon Equity website or our profiles on LinkedIn.
Perfect. Thank you. Bye-bye.